Welcome, everybody. Today we have the privilege of chatting with Mohnish Pabrai, who's an absolute legend in the value investing community, as you all know. We have a huge turnout for this event. We're also super thankful to AlphaSense for sponsoring this and just helping us, put this all together. Mohnish, great to see you again. I think this is the third or fourth time we've done one of these with you. Although the second time that we've done it from your new library, which I'm always excited to see the background. I wanted to start off with something that I know is near and dear to your heart, and that is Berkshire. Um, uh, Greg Abel is taking over, I think, January 1st. And I think in the past you've said that you almost view Berkshire stock as almost a placeholder for periods of time when you don't have a big, investment idea or high conviction idea to put fresh capital into. And I'm wondering if you still feel that way, and if kind of the passing of the torch to Greg at all changes your thoughts on Berkshire as as an alternative to the S&P 500, or as a placeholder, I guess, for those of us who are more involved in active investing.
Yeah, well, Divya, it's always a pleasure. Great to be here for our annual banter. It's very wonderful. And regarding Greg and Berkshire, so the baton actually was passed a few years ago. So Greg actually, from a practical sense, has been running Berkshire for quite some time. So Warren had passed over all of the wholly owned companies to be under Greg a few years back. And and that's, the thing is, that's where most of Berkshire is. And there's a few things that Warren is still handling, like the public portfolio and so on. And those are going to get passed on in the next 6 months or so. So, from a practical point of view, we've already seen Berkshire running under Greg's leadership for some time, and we haven't noticed any difference. There's the baton got passed, and we didn't even notice anything. And I think that as we look at the situation today, Berkshire in many ways is like an index. It's like investing in an index fund, but I think today it's actually a better index to invest in than the S&P. So in the past, like I said, like you mentioned, I've thought of it as a placeholder, but actually it's a better vehicle. I mean, now we have passive investing is more than half of all investing in the U.S. And one of the negatives with passive investing, we still don't see the extreme impacts of that, is that you get this lemming behavior where a few stocks, get money allocated to them regardless of fundamentals because they're in the index. And so that's why we see some of this Mag 7 stuff and all of that going on. But yeah, I mean, I think given Berkshire's large cash position, modest valuation, relatively young leader, it's a good place to be.
Is his ethos the same? I mean, I guess, they're different people. I hear your point that he's been there for a while and you haven't noticed a difference, but do you, Buffett himself is a unicorn. And so obviously tough to replicate him exactly. So as far as kind of making new big bets, do you feel like his ethos is the same, or if it's different, how is it different? If you have
Well,
any
they're
sense on
different
that.
leaders. We will never have another Warren Buffett. I mean, that's one and done. Okay. Just like we're never going to have another Jesus. Okay. So Warren, Munger, and all of those. I mean, that's the leaders of the church. That's just not going to change. Um, you know, Charlie used to say that Greg has some important qualities that are superior to Warren. And he never really expanded on that. He never really kind of went on to explain what those qualities were. But one of the big differences between Greg and Warren is Warren has always been very hands off on the subsidiaries. Like he said, delegation to the point of abdication, right? So these subsidiaries were left on their own. Uh, Greg is a lot more hands on, and so he is interested in some type of optimization and some sort of oversight into making sure that these very large, wonderful businesses in Berkshire are getting to their potential. So Warren, for example, never pursued synergies between the different subsidiaries. Greg actively pursues that. Greg actively has the different CEOs interact and meet with each other and all of that. So there is a lot more rolling up your shirt sleeves and diving into the individual businesses. And so I think that um, we may see somewhat better performance coming out of the existing subsidiaries. I think where Warren stands almost unrivaled is basically in the deployment of capital, right? So he is just exceptional. Though he did make mistakes, not being aggressive enough in 2008 and 2020 and so on and so forth. Greg, I think, may do better in those periods. And the one final area where Greg has a big advantage is the US grid and the US energy footprint needs a huge step function in investment because we've got all the AI and data centers and all of that happening, and it's a mind-boggling number in terms of how much needs to go in, and Berkshire would be kind of the perfect company to leverage that because they have a very large subsidiary in energy. The negative is that there's been issues recently where a lot of liabilities have been passed to utility operators through the court system, the California fires and so on, bankrupting utilities and such. And so Berkshire actually was actually blindsided by that. And so they're going to look for a lot more legal protection on that front. But I think that's a big opportunity for them.
That's really interesting. I mean, this almost sounds like a little bit of a Tim Cook versus Steve Jobs question. But if it ends up being that Greg is more of a Tim Cook, kind of a great operator, that's obviously not a bad outcome for Berkshire.
Well, he's also a very good capital allocator. I mean, one of the things is Tim Cook is not an innovator.
Right.
Tim Cook is not Steve Jobs. Okay. And if we look at Apple since Steve Jobs, effectively there's no innovation. Because Apple is a very unusual company. Innovation was always concentrated in one person. It was just driven down. It's very different from a Google or a Meta or Microsoft and so on. It was very singularly concentrated in the case of Apple. And that's why Apple's always been a company with very few products and very exceptional products because, it was the one guy driving it basically. I think in the case of Berkshire, Greg Abel is definitely more of an operator than Warren is, but he's an exceptional capital allocator as well. No one will be as good as Warren Buffett, but Greg is extremely smart about the capital allocation and making quick decisions and all of that.
So you mentioned Mag 7. I have to ask you, of the 7 names, you have on one extreme Tesla, which has, you could argue declining sales growth on the car front, lots of competition, but lots of promise with robo-taxis, which is this like somewhat crazy future that, maybe is a few months away, maybe is a few years away, who knows. On the other hand, you've got Google, which is an incredible franchise, incredible brand, historically thought of as a monopoly, but now people are calling that into question. And you're seeing that in the stock. have you, I know like, Mag 7 isn't your thing per se, but have you looked at any of the names? And I spotlight Google because it's, trades at the lowest multiple, arguably a sub-market multiple, trades cheap relative to the S&P and to the group. Just curious if you've looked at it at all, given kind of its the last, 5 or 6 months.
Oh yeah, well, the Mag 7 are such a central part of the economy, and they're unusual in the sense that they're very large and still growing at ridiculous rates. I mean, we normally don't see, huge companies growing at spectacular rates, but they're still pulling rabbits out of the hat. Munger used to say about Elon, never underestimate a man who overestimates himself. And it actually took me, and I still don't fully understand that sentence. But that sentence actually comes from Charlie's experience with these people who are, outliers, extreme outliers. So I would never count Tesla out, just because, I think when you get someone like Elon all in on something, it's like, there are no boundaries. So it's really.
I certainly don't count him out. I just figured, given your tilt in terms of.
Well, what I'm saying is that, I mean, from my point of view, it's difficult to invest in something like Tesla, especially difficult to invest in something like Tesla in anything resembling a 10% or bigger bet in my portfolio. It would kind of veer towards the speculative, simply
Sure.
because Elon gets distracted. He goes and runs the government for a while, and he's got so many things going on. But probably a mistake on my part. I think that not being long Elon is probably a mistake. But we've made a lot of mistakes like that. I would say this, that a company like Google faces real challenges in its core business. Now, they've got, I mean, if you look at something like the YouTube franchise, I mean, that's just so spectacularly mind-blowing that, it's a rock, not going anywhere. And of course, Android also is great. But I'm just saying that search is threatened in a way that it wasn't threatened a few years ago. And Google has woken up to this. They're fully focused on it. They'll probably come out okay, but it's not the cinch that it was a few years back. So to me, the Google multiple being low isn't really a strong signal that one should go out and buy the stock. I think that the one that I really think is as close to bulletproof as you can get is Microsoft. I think because Microsoft is so embedded in the enterprise, and because enterprises are like aircraft carriers, they cannot turn on a dime. They can't suddenly say, "Oh, I'm going to use someone else for search tomorrow." We can make a decision 5 minutes from now to never use Google search and not even think about it again. But you can't do that with a lot of Microsoft products. Those are just so deeply entrenched and embedded. And Satya is such an exceptional leader. And so to me, of course, Microsoft, the multiple is higher. And it's interesting. I think it was like 2 years ago, I think about 2 years ago, where I was in Omaha, and Friday night, usually Munger used to host a dinner for friends, family, and some Berkshire managers, about a couple of hundred people, and Gates would always show up for that. And I think 2 years back or 3 years back, Munger's daughter-in-law pulled me aside and said, "Mohnish, I don't want you to freak out, but you're going to be sitting next to Bill." And she said, because she did all the seating for the dinner, she said, "The reason I seated you next to Bill is because I know you won't ask him anything. You won't ask anything of him." I said, "Oh, that's the furthest thing from my mind." He said, "Exactly, I know that." So So I get seated next to Bill for like 3 hours. Okay. And we were having a great conversation. So I played a game with him. I said, Bill, I'm going to mention stocks and you tell me whether you're going to go long or short or indifferent. And he said, yeah, sure. And so when I mentioned when I mentioned Apple, his reaction was that, and this is the guy who used to be in Berkshire's board, and he's with Warren and all of that. And so he says, well, that's a very weird company. And he says, and what he was basically saying is, it's all so heavily concentrated in these few products, right? I mean, if you really think about it, I mean, what OpenAI is trying to do with Johnny Ive coming in, right, is take the brick out of our hands, right? So if you take the brick out of our hands, where is Apple, right? And I mean that's where what they're trying to push towards is, you can't make a better brick. You just need to take the brick out, right? And it's weird to go around with a brick, actually, even though it's a nice slim brick. But it's weird to go around. So it somehow needs to get integrated into us.
Well, that's
And
why Meta is spending billions on glasses and other wearable
yeah,
tech. I'm
so
sure
if
so
if
much.
if we ever get down that path where the brick gets threatened, then you have a problem, right? Apple has a problem then, because they don't have Steve leading them to take them to the next paradigm. I have a concern whether Apple can get to the next paradigm. And so that was Bill's case. He said, well, it's a weird company, right? I mean, that's the way he put it to me. And he wasn't bullish on, putting a big bet on Apple, while his best buddy is all in on Apple. Of course, he's lightened up. So I think when you look at these different businesses, uh, Tesla probably what the best thing is, have a small allocation, just because Elon is there and things can happen. Um, Google, I would say, falls into the too hard pile. Apple falls into the too hard pile. Meta is a juggernaut. I mean, it deserves something.
Well,
Um,
last time we talked about Meta, it was at
yeah, I mean, I never bought it, but it was a great call.
I think it was $100. Oh no, I think at the time you said it was an easy double,
Oh
which would
yeah, it
have
was E-double. I think that was a great valuation, and I think that Meta is different in the sense that we have Zuck at the helm, and
sure.
he's a smart guy, and he's shown an ability to be a chameleon. I mean, you can't pin him down and say this is Zuck, and so I think he's still a learning machine and all of that. And I mean, if you just look at Meta, their acquisitions, it's mind blowing what they've been able to do. I mean, only Google with YouTube can kind of rival that in any way. And so Meta is not at the El Cheapo price it was a few years back, but firing on all cylinders. I think Microsoft firing on all cylinders, going to be there. So that's that.
Yeah, I mean, on price, like when you look at a Microsoft, um, I think it probably trades 30 to 35 times
Yeah,
earnings, something like that.
it's
Um,
high.
Meta's a lot cheaper, but call it probably
Yeah,
mid.
but it's the thing is the recurring revenues
Sure. Yeah.
is a really really powerful thing to pay up for.
So my question is, I mean, you've said this also before that, you're better off owning a name that has long-term growth ahead of it. So you don't have to get too fussy about the specific multiple at which you purchase in, your entry point. Is there but at the same time, like I don't think, and correct me if I'm wrong, I don't think you own either of those two names within the
I have no Mag 7.
yeah, that's incredible. So uh
But I'll just go a little further, Divya, so you can kind of see kind of where I'm coming from. And I was thinking about this for the last few days. Is in 2023, I made a bet on metallurgical coal, somewhat different from the Mag 7. Okay. And in 2025, this year, I made a bet on offshore oil drillers, also somewhat different from the Mag 7. Okay. Now, I never thought about it in these terms, but when I look back on these bets, um, even though the decisions are made completely independently, not looking at one versus the other or any of that, they're in very different spaces.
Mm-hmm.
There's a commonality to them, which I didn't even realize till after I'd made all the bets. And the commonality is that we've got like kind of four positions. All four of them went through bankruptcy restructuring. And all four of them basically came out with pristine balance sheets. All the debt was restructured and converted to equity. And these businesses are businesses historically that were always heavily levered. They're just very capital intensive businesses. So to have a miner which is debt free is like an oxymoron.
Yeah.
Okay, it doesn't exist. And these four businesses were all debt free. Okay, not only were they debt free, um, when you looked at anything resembling replacement cost of their assets, um, in the case of the offshore drillers, one could argue that they might be trading at 10% of replacement cost. Okay, 1/10. So now we know that the holy grail of investing is to invest in capital light businesses that generate really high returns on equity. But when you have a business which needs a lot of capital, but you got these capital assets without paying for them, then in my book they start looking like a capital light bet. And in fact, that's probably what drew me in, is when I look at the return on equity of these businesses, uh, it's spectacular. And the reason it's spectacular
Yeah.
is because uh, you know the assets would cost maybe 10 or 20 billion, and you got them for 2 billion. Okay.
Let's talk about the metallurgical coal group first. So I don't know if you want to start with Warrior, but I hear your point on replacement cost. I'd love to hear how. First of all, how did you learn that there was this, you know, this extremely large discrepancy between the cost of building, you know, let's say the mine today versus what maybe they spent originally to build it. But if you can just walk me through your Warrior thesis on a simple level, that'd be super interesting. I have a sense I know where you're going to go, but I'd love to hear you out on it.
Well, in the last, and I'm not in the stock tip business, so this is just a discussion.
Totally
I'm not.
understand.
I'm not asking people to go buy the stock. In fact, I think you shouldn't buy the stock listening to some talking head. Not a good idea to do that. So
No,
please
but
do
I think
your
it's
own.
a great example of your
Yeah.
philosophy.
So in the last 2 years, I spent a lot of time with miners. I spent a lot of time in the mines. Um, Thousands of feet below the surface. Spent time at the coal terminals, uh, watching the trains getting loaded and ships getting loaded, all of that. And even made a trip to Mongolia to see one of the largest surface mining metallurgical coal operation, which was spectacular. That was a great trip. And so I feel like last couple of years I've been drinking from a fire hydrant, and still a lot to learn, but it's been great. So if you look at a business like Warrior, and I've visited them a few times, and a wonderful, actually, truly exceptional management team. Coal miners are just the best people, you know. They feed you well, and they what you see is what you get. It's just awesome. Um, and anyway, so in the case of Warrior, um, their mines are some of the best metallurgical coal mines in North America. And they have amongst the lowest cost of production. They have two big advantages. So their mines are in Alabama, Southern Appalachia. Okay. And their mines are not that far away from the port. Uh, coal is a commodity that is very expensive to transport because it's very bulky. You don't get paid much per ton, and the transport cost per ton can be very high. So logistics with coal becomes extremely important in order to, have a business that can actually make money. And Warrior does something known as long wall mining. There are two ways to do it. You can ask Google about this. Long wall mining versus room and pillar mining. Long wall mining is basically the most efficient way to have an underground coal mine, where you basically have these huge blocks of coal, and you're having a shear go end to end, and it's already automated. So Warrior's cost of production for very high quality metallurgical coal, and metallurgical coal is only available in like half a dozen countries around the world in any kind of sizable quantity to be exported. So they produce very high quality coal. They produce it at a very low cost, and they've got rivers that can take them to the port, which is they can barge the coal down, and they've also got multiple railroads. Whereas some of the other miners, they've basically got one railroad servicing them, and it's the railroad that makes all the money because they've got a monopoly on the transport. So in effect, when you look at Burlington Northern, which Berkshire bought, one of the first trips Buffett, Munger, and Gates made after they bought Burlington Northern is they went to the Powder River Basin in Wyoming, because that's where Burlington Northern made so much money with transporting coal. And these guys went and wanted to take a look at that facility because it was so they didn't own the coal mines, but they basically owned the coal mines because they were the only toll bridge to get your coal anywhere you wanted it to go. And so basically, Warrior is a low-cost producer, cheap transport to the port. Once you get to the port, then coal is easy to transport anywhere in the world. And so pretty much in almost any environment you can imagine, Warrior will be making money because they're so low on the cost curve. So basically, you have a debt-free business that is extremely unlikely to ever have a money-losing year. And so, Warrior is like, 2 to 3 billion market cap, maybe 2.5 billion or something. Their reserves are going to go for 40, 50 years. They're going to have some years when they're going to produce 1 or 2 billion in cash flow. And there are going to be some years that they'll produce 500 million in cash flow, and there's some years that they produce 300 million. So if you're paying 2.5 billion for a business, and those are the numbers, where do I sign?
Right.
And I don't get that with the Mag 7.
So Mohnish,
I don't get a 3 trillion market cap with 1 trillion cash flow ever coming out in a single year.
So one question I have, I mean, a lot of these situations, like this situation you're describing from a valuation standpoint, I mean, if you're correct about the fact that, they could potentially do $1 billion in free cash in a given year.
It's not even theoretical. They've done it in the past.
They've done it in the past, right? Yeah. It seems like it begs the question, like, well, why on earth is the stock trading where it is? I was reading
it's a 4-lettered word.
Is it that simple?
You're not allowed to utter the 4-lettered word.
So here's another point. I was reading this conference call transcript on AlphaSense where there was some expert who was saying that people confuse metallurgical coal with thermal coal.
Yeah, so basically, there's a lot of difference between thermal and metallurgical coal. Thermal coal is available across the globe in a gazillion places at various grades, low grade, high grade, whatever, right? The extremely high grades of thermal coal kind of border on being usable for metallurgical uses. But the extremely high grades are very rare. Metallurgical coal sits in its own universe. And this is one of the reasons why everything gets painted with a broad brushstroke. And so you really have to separate thermal coal for metallurgical coal. We will not have a civilization without iron and steel. And we cannot produce enough iron and steel just by recycling the existing iron and steel. So the only way you would not use metallurgical coal in terms of all the known processes of how to produce iron and steel would be to recycle steel. The problem with recycling steel is places like India and China, et cetera, do not have enough scrap steel to take care of what their needs are. So usually it's advanced economies like the US or Japan, which have a lot of recycling of steel going on. In the United States, we scrap a lot of cars, right?
Mm-hmm.
I mean, we have 15 to 17 million cars a year, new cars being sold, and probably a somewhat similar number being scrapped. And there's a very efficient mechanism to get that scrap steel. Most of it gets exported to China, etc. But we don't have enough scrap steel. And also, you cannot produce the highest grades of steel by using scrap. So basically, at the end of the day, places like India or Indonesia or Vietnam or eventually Africa and so on have huge appetites for iron and steel that cannot be fulfilled by recycling your way through it. So 50 years from now, we will still be burning metallurgical coal to produce iron and steel.
And this is another thing we've talked about, is that you've moved, I think, your own, all else equal, you would prefer to buy names that you can sit on for decades, potentially forever, right?
Sure.
Like I wish I had bought Microsoft when I was, a preteen, using, Windows operating system back when there used to be like a 386 processor, made by Intel. And that could have been my one position, and I'd be, very wealthy just from that one, trade alone.
Well,
I'm getting
Bill
a little.
Gates feels the same way. He wish he had kept his Microsoft stock. So don't
Yeah.
beat yourself up too much, Divya. It's okay.
He must be a little annoyed that Bombers kind of profited off of all of his work, starting the business. But one of the things you've talked about in the past is mistakes you've made with respect to selling positions, where maybe you're up 3x on a stock and you're like, oh, I'm up 3x on a stock, I'm going to sell and get out, when really you may miss another 20x or so of gains. How does that experience kind of impact the way you think about holding,
I think we are old too soon and wise too late. This is the story of my life. And absolutely, it took me a long time to learn that there are very few truly great businesses and truly great compounders. Very, very few. And when you find yourself in the happy position of a partial ownership of one of those types of businesses, don't get cute by selling when you think it's overpriced or fully priced, because you really don't know what that is. And so until it gets crazily, egregiously overpriced, and it's obvious that that's the case, if it's a great business that's still firing on all cylinders, just keep it.
And what would be kind of that break point for HCC? I mean, is that it gets a market multiple, or what would you say is?
Well, I would say that none of the Mag 7 currently sit at a point that I would call egregiously overvalued.
Yeah, I would agree on that.
So basically, if you own them, I would just keep them.
Yeah. Now, let's talk about, I don't know if you want to do like Noble or Valaris first, but
well, they're also very similar in the sense that the last time, okay, so a drill ship, which is one of these things which would today cost around $1 billion to build. Basically, it allows you to drill deep into the ocean without really having floor or kind of feet on the ground, if you will. They're ships that they've got a kind of hole in the middle to allow drilling and so on. It's really a kind of engineering marvel. So the last time one of those ships was built was about 10 years ago. And the industry went through a crazy orgy of overbuilding about 12 or 13 years ago, and then it went into a total nuclear winter where there were so many ships delivered, and almost all of the players went bankrupt because they were so highly levered and rates collapsed and all of that. And when we look at the situation today, uh, things have come back into balance. A lot of the older ships have been scrapped. Nothing new has been built. And so when you look at a company like Valaris or Noble, and just if you were to just look at their fleet and say, okay, um, what would it cost to replace this fleet, right? Well, the cost to replace this fleet would be like maybe 10 times the market cap because they're just trading at such a extreme end of the thing. And the second is that the current day rates that you get paid for drill ships and jackups and all of these um, does not justify a new build. So, for example, a new drill ship, which would cost, let's say, 1 billion and would probably take you 4 or 5 years to get delivery, would require day rates in the range of 7 or 800,000 a day to get some reasonable cost of capital back, like make low teens return on your capital. So you would need to get about 800,000 a day to get a 12% or 14% return on your capital, which is reasonable. And day rates today are in the 400s. So basically, you cannot go out and build a ship today, and every day and every year, ships get scrapped. And so this market is coming into a tightness. The other thing that people don't realize is that offshore drilling for oil has a very low cost. So, like for example, in Brazil, which has huge amounts of offshore drilling, the cost of producing oil is $20 to $30 a barrel. It's almost half of what it cost with fracking to produce oil offshore. It's long cycle time, high capex, but effectively when you amortize it, you get to the $20, $30 a barrel type price. So it's very profitable. And so basically, this is a situation where these companies have no debt or very low debt. They basically have great assets, and the market is gradually tightening. And if rates were to go, for example, from the 400s to 6 or 700 a day, I mean, Valaris and Noble, I mean, they would be just um, printing almost the entire market cap in cash every year.
Hmm.
So that's why Mohnish is there.
As the just curious, I mean, when we were talking about steel, I mean, so Trump's been in the news a lot of trying to revive the American steel industry. You would think that some of those headlines would have had maybe a somewhat more positive impact on the stocks themselves. Are these names just is it a situation where there's just not enough research coverage, or I'm just curious, like why we're not seeing more of a positive reaction, or is it just the world sees kind of global manufacturing coming down because of tariffs that they don't.
Well, so sell side coverage on the metallurgical coal names is almost non-existent.
Got it.
And the reason there's no coverage is these companies. Um, I'll give you an example. One of these companies whose CEO I was speaking to said to me that they had a 60, 70-year-old relationship with JPMorgan, banking relationship. They've never gone bankrupt. They've always been profitable, very profitable banking. And JPMorgan told them, we cannot have you as a customer anymore. Please find another bank because we have too much ESG pressure. So this is a highly profitable relationship for JPMorgan. Hundreds of millions of dollars going through. They're not borrowing money. They're not going to default on anything. They're never going to be a money losing client. You're collecting all kinds of fees on letter of credit and all of that. Why would a JP Morgan say to them, I don't want your business? when I've had 5 decades with you? Well, they're saying it because of irrational reasons, right? And so these companies have a hard time getting insurance, getting banking relationships, uh, getting anything because they're a pariah. And so on, it's not just on the like there's sell side coverage or no sell side coverage. It's like when they're trying to get insurance, like workers' comp insurance, for example. So these companies are self-insuring, first 10 million in claims per worker covered by the company, right? They just need someone to give them a policy because it's required by law. Effectively, they're self-insured. They still have difficulty getting insurance because there's a bunch of companies who will not write that type of coverage. And so surety companies, same issue. They need sureties for their mines, and again, they have difficulty. So many things that they need for their business, they repeatedly have difficulty getting. And so all of that, what that means is that for a new company to start in this industry, or new mine, or a mine that's been shut down to restart, the factors to start it are so challenging that effectively we're going to see a shrinking pool of productive mines at a time of increasing demand.
Now, what level of access do you typically have? Obviously, you've been doing this for a long time, to the management teams. And is that something you require when you underwrite a new position? Like, so do you know the CEO of the offshore drilling companies you're invested in, or the coal businesses? If you haven't met,
We've spoken to most of them. We've met most of them. Um, because they're treated as pariahs. If I call, they'll take my call. Nobody wants to talk to them.
right?
So they're happy to talk to Mohnish, but it's not needed. For most of my career, I didn't even speak to management teams. I think that for these coal names, you really don't need any access. I mean, to me, what was more interesting was the site visits into the mines and meeting the foot workers. The head of mining or the head of safety or someone running the coal terminal, that sort of thing. So those guys, I think, were very valuable in terms of helping me build domain knowledge
Mhm.
on how this business works.
How's your exposure now in Turkey? I know we had spoken about that on our last call. Are you still invested in Turkey at all, or are you completely
Oh
out of
yeah, long and strong. you know So I mean, basically, it took me a long time to figure out that when you have something good in your portfolio, you don't need to do anything with it. Leave it alone.
it? Are you still
And
in there,
so
or
we have some exceptional businesses in Turkey. I think we bought them at very compelling valuations, and there's no need to do anything.
is this the airport operator,
Yeah,
or
the airport operator, the warehouse operator. I mean, their businesses are on fire.
what's the name of the airport operator?
It's called TAV Airports, TAV.
Hmm, got it.
And I mean, TAV Airports basically, the airport operator. So in the US, uh, all airports used to be government owned and government run. Okay. We now have one airport in the United States that is privately run, which is LaGuardia. Okay. And you know what an armpit LaGuardia was before. Okay. Like you would avoid it like the plague. Okay. And now it's the preferred airports to go through. You know, the one to avoid is Newark. So you don't want to go anywhere near Newark. And but LaGuardia is an interesting case because the first time in the US that they've actually given it to a private operator for a long period, and they transformed the airport. So 96% of airports around the world are government run and government managed, and maybe 4 or 5% are private. And these private ones, like in India, almost all the big airports are all privately operated. They are BOT models, build, operate, transfer. And it makes all the sense in the world, in the sense that the country gets a great airport without putting up any capital. A great operator runs it for a few decades, then gives you all the infrastructure back to the government for free, and you go on from there. And so TAV Airports actually is a wonderful company because it has operating leverage. When passenger traffic goes up 5% or 10% in a year, their costs don't go up. It's pure operating leverage. And so over time, their cash flows are just exploding. It's a beautiful business.
And speaking of India, I think we had previously talked about the National Stock Exchange, maybe briefly, and then there was an energy trading company. I think you had spoken to me about
Indian Energy Exchange, yeah.
Indian Energy Exchange, yeah. Did you ever put a position on in any of those names?
We used to own IEX. We don't own it anymore because there in the middle there was a lot of rumbling that started happening that the government was going to destroy that monopoly. It became very hard for us. We went in the too hard pile. In the end, I think IEX is going to prevail. It's a beautiful business, but it became just difficult for us on that front. The National Stock Exchange in India, NSE, that's actually not a listed company. It's a private company. And it'll probably go public in the next maybe year or two, probably. And it's a great business.
Yeah, I was reading your daughter's write up on it. It's pretty compelling. This is great. Now, I guess one thing before I want to check to see if anyone has any questions as well, but we're in a very macro-driven environment right now, and there are a lot of investors who are just like on eggshells with respect to rates. Trump's every now and then he bashes Jerome Powell for not lowering rates, and has the interest rate environment at all had an impact on how you were thinking about portfolio allocation? It sounds like the coal names don't even have debt, so maybe it's less of an issue there. But certainly from a valuation standpoint, multiples generally come down if rates are high. Just curious if you've
Well, I think the seesaw with the tariffs is really, really damaging to the U.S. economy. I mean, those are some things you don't want to change on the fly. And I agree with Trump that trade should be free and fair. And I also agree with him that the US didn't have the fairest deals with a lot of countries. They were taking advantage where it wasn't symmetrical. But to go in with a sledgehammer and then keep changing things every few days or every few weeks or every few hours is really very problematic. So I wish they had taken a more kind of surgeon's precision approach where, go to the large trading partners one by one and sit down with them and redo the deals without, saying, okay, tariffs are 150% and now we'll sit down and talk, that sort of thing. So I think that it's been it's already caused a lot of damage, I think. And I'm hoping now the good news is that they say they're going to have a deal with China, which would be very helpful. But they really need to get the largest trading partners into a space where they're not on quicksand. Whatever, and that's the other problem that the partners have is they feel the US is unreliable because they feel that whatever deal we come up with, it might change in 3 weeks, and so that doesn't bode well. But I agree that I think that people in the Trump administration need to spend more time with Adam Smith and David Ricardo. I think that some basic econ lessons are lost. And I think that a lot of the trade where we got to was based on Adam Smith and David Ricardo, which is why we were doing well. Now, I agree that there were unfair situations or countries taking advantage of the US and all that. And yes, that should get fixed. And I'm glad Trump is fixing it. But going through bull in a China shop, just not the right way to do this.
What's your take on the big, beautiful bill? Obviously, there's no bill yet, but it's certainly a big headline. And You know,
Well,
on the one,
I'm in Elon's camp. I don't think we should have bills which increase the deficit.
right.
I mean, I think Elon saw firsthand how hard it is to cut, how hard. And then he sees this bill which is going to add a few trillion. And that just probably, rubbed him the wrong way. And when he's even to get 50 billion of expense reduction is very hard, right? I mean, everyone fights you all the way. So I think that any bill which is going to not reduce deficits, not a good idea.
But if we do end up with a bill that creates, maybe it's not 4 trillion of excess deficits, but maybe it's 2 trillion of excess debt. We'll see what the
I
Senate.
don't think we can. I don't think we can afford even $10 more of excess deficit.
Yeah.
I think we already are push. The thing is, the U.S. is pushing all the limits. I mean, we borrow in our own currency, which gives us a lot of leeway, but really, I yearn for the days of Bill Clinton when the budget got balanced and actually had a surplus.
But does the ongoing deficit, I mean, how does that telegraph into your portfolio? I mean, does it impact your portfolio at all, or how
It
do you?
does. I mean, I think all the tariff stuff that's going on right now, it's not so much a deficit, more the tariffs, um, is going to create huge recessionary pressures globally, in the US and elsewhere. So it's not so much the interest rate. I think interest rates are benign relatively right now. But I think the tariffs, you're playing with fire there.
Mohnish, we have a long chain of questions. We're not going to go through all of them. One easy one. What are you reading right now?
Well, the book I've recently enjoyed is Buffett and Munger Unscripted. So this guy basically went through all the Berkshire annual meetings online, which are on buffett.cnbc.com. And he basically reorganized them by subject. And that's a yeoman's effort. I mean, that's a lot of effort to do that. Not easy to do. Maybe AI makes it easier, but he did a masterful job of that. So someone had done this. Larry Cunningham, the professor in New York, had done this for all the Berkshire annual reports, where he reorganized them by subject. So if you wanted to know what Buffett ever talked about, said in his reports about inflation, or about capital allocation, or about return on equity, any of these things, you could read that. But now we can do that with and the annual meeting stuff is even better than the annual reports, because the annual meetings is unscripted. He is not coming there knowing what questions are going to be asked and knowing what the answer is going to be. And you got Munger in there too, who's throwing in his input as well. So I think that the wisdom that came out of all of that, and to be able to reorganize by subject, that's fantastic.
Now, you've got a lot of Asia investing experience. Have you been bargain hunting in China at all?
I don't approach it that way. I look at it more in terms of I look at it bottoms up. So I look at it from a company point of view.
Mhm.
And last couple of years, we found these things in the US. We found met coal in the US, and we found the offshore drillers in the US. Now they're global businesses, and they're export powerhouses. They're sending stuff all over the place. And other things being equal, I prefer US governance over anything else, right? And so I was able to get US governance, and it's difficult. I think it's very difficult from my vantage point to top what we found in Turkey, and what we found in the met coal, and what we found in the drillers. So basically, like I said, bottoms up, we look at things that are hated and unloved or being discarded, and that's where we go looking.
Have you maintained your, I think you'd mentioned, wanting to own 10 companies in equal size. It seems like you have 4 companies.
Well, when we make a bet, we ideally want it to be a 10% bet, right? So in an ideal world, if I'm starting out on day one, and I had 10 ideas, it'd be 10% each, right? Now, what happens is that when we buy something at 2% liquidation value in Turkey, like we did, and goes up, it's going to become like, 40, 50% of the portfolio. And we're not going to trim that because it's still undervalued. So basically, if you are successful as an investor, you are going to end up with 80% in a single position.
Mm-hmm.
And one should not have that much reservation about it. If we look at the Walton family and Walmart, for example, when Walmart went public, 55 years ago, the Walton family owned about 46% of Walmart. And if you look at it today, they own 46% of Walmart. Okay. And I mean, Sam Walton died 33 years ago. And the founder passing away and leaders changing and all of that, they haven't done anything. They've been running this thing the way Balmer does, set it and forget it, right? And the dividends that have come out of Walmart, if you ever visit Bentonville, one of the best places on the planet to live. I mean, what they've transformed that into, it's a biking mecca, it's a cultural mecca. They've just transformed the place. It's incredible. And that's all come out of the dividends. They've never sold a stock. And so basically, it's a very natural thing for entrepreneurs to be very concentrated. And investors need to understand that when you do things well, you're going to end up with heavy concentration in a few businesses, and that should be okay.
I want to
so hard to find.
I want to end on a positive note. We've talked about, I guess, some of the volatility with respect to the way the world's operating nowadays. I mean, what are you most optimistic about from a geopolitical standpoint, and also from a more domestic policy standpoint, if anything?
Well, I'm always a bull on America. We are somewhat playing with fire when we turn away the foreign students. That's a big. The tariffs are the big no-no from my point of view. The way it's being done, the foreign students being messed around with. It's a huge American export, one of the best American exports. I mean, you're talking about uneven trade. This is a great trade, and we're turning away the tourists, which is another huge American export. So I get really concerned when we start playing with the crown jewels like that. I'm hoping all of this cooler heads would prevail, and we should be making it easier to get the best talent in the world in. The United States have done extremely well with the best talent coming in. You look at the Mag 7 and look at who's running them and senior people in the company and all of that. I mean, you take the foreign talent out, and there's a problem there. And so we really need to leverage those strengths, pull the best talent from around the world, hopefully make the trade free and fair again, and let the country do what it does well. Just let it rip.
I think that'll resonate with most of the folks on this call. Hopefully, everyone. Mohnish, this is great. What a privilege. Thanks again for taking the time and imparting your wisdom to all of us, disciples of value investing. And yeah, it's been great chatting. We'll look forward to the next one, and hopefully, maybe we can do something in person one of these days as well.
Oh yeah, that'd be great. Well, Devi, I always enjoy our banter, so thank you so much.
Absolutely, Mohnish. Thanks so much, and thank you, AlphaSense, as well for sponsoring. Looking forward to doing this again.
All right. Bye.
Thanks, everyone. Bye, guys.
See you.